All right, today we are pulling back the curtain on the financial engine that quite literally builds our cities. It's a world that runs on just two acronyms. That's it. Two simple codes that decide if a skyscraper shoots up into the sky or just stays a drawing on a blueprint. And if you understand them, you really start to understand how the modern world actually gets built.
I mean, think about it for a second. You walk past an empty, forgotten lot one day, and then you blink, and a few years later, it's this gleaming tower. That whole transformation, it's not just about steel and glass. It's a super high-stakes financial puzzle. And the secret to how it all works? It's hidden in the language of the bankers who make it all possible.
The real answer is all about how developers convince banks to hand over hundreds of millions of dollars. And it all boils down to two key metrics: LTV and LTC. You can think of them as the gatekeepers of modern development. They're the numbers that turn a vision into actual physical reality. So let's frame this with a story. Just picture a developer, okay? She has this incredible vision for a piece of land, a brand new state-of-the-art apartment complex. She's got the plans, she's got the drive, but she needs capital, a lot of it. So her very first stop is the bank. Now, before a bank is going to lend a single dollar, they have to, manage their risk. So for a building that's already there, one that's built, stable, bringing in rent, the bank has something real they can measure. They start with one simple question: what is this thing worth right here, right now? And that's the value test.
And that brings us to our very first term, loan-to-value, or LTV. It's really just a simple ratio that tells the bank what percentage of the property's current value they're on the hook for. The really crucial part, though, is they always use the lower of the purchase price or the official appraised value. It's their safety net, and it protects them from lending you money on a wildly inflated price tag.
The formula itself, it's incredibly simple. You just take the loan amount you want and divide it by the property's value. That gives you the LTV percentage. Now, banks have really strict limits on this number, and it changes depending on what kind of property it is and what the market's doing.
So let's put some numbers on this. Say our developer wanted to buy an existing building for $10 million. If the bank's maximum LTV is 75%, well, the most they're ever going to lend her is $7.5 million. Simple as that. She has to find that other $2.5 million herself.
But hang on, what about our developer's dream project, the one that's not even built yet? I mean, you can't get an appraisal on a building that's just a stack of blueprints. For brand new construction, banks need a totally different yardstick. They need the cost test.
And this brings us to our second key metric: loan to cost, or LTC. So instead of looking at a property's value today, LTC is all about the future. It measures the loan against the total all-in budget that's needed to turn that empty lot into a finished, money-making building.
So, what exactly is in this cost? Well, that's what's so interesting. It isn't just bricks and mortar. We're talking everything. The cost of the land, the architect's fees, the lawyers, the permits, the interest on the loan itself, even a fee for the developer and a rainy day fund, just in case. It's the total real-world budget from start to finish.
And hey, just like LTV, the formula is beautifully simple. You just divide the loan amount by that total project cost. And again, banks are going to have a maximum LTC they're willing to go to, usually somewhere in that 65 to 75% range.
Okay, this is where it gets really fascinating. For a big development project, a smart lender doesn't just pick one of these metrics. Nope, they use both. They run a loan-to-cost test on the budget, and they run a loan-to-value test on what they think the project will be worth once it's done. This creates what I like to call the banker's double lock.
So let's run the numbers for our developer. Her total cost is $11.5 million. The bank's max LTC is 70%, so that gets her a loan of about $8 million. But wait, the bank also runs that second test. They figure the finished building will be worth $16 million. And if they apply their 75% LTV to that future value, well, that would support a loan of $12 million.
So there we have it. Two different tests, two very different loan amounts. One's for $8 million, the other is for $12. So which one does the bank actually approve? Does she get that bigger loan her project's future value seems to justify?
The answer? It's always the lower of the two. This is the perfect illustration of how a bank thinks. They will always, without fail, fund a project based on the more conservative, more restrictive calculation. So in this case, the loan based on the actual cost, that $8 million figure, that's the one that wins. That's her limit.
This is the unbreakable rule of real estate finance. So why? Well, it's because the LTC test protects the bank during the riskiest part of the whole deal, the construction phase. By tying the loan to the actual cost, they force the developer to have a significant amount of their own money in the project from day one. That forces discipline and makes sure everyone is laser-focused on getting the thing built on time and on budget.
Okay, so the bank has put up about $8 million, but we know the total project cost is $11.5 million. That leaves a pretty big gap, about $3.5 million. So where in the world does that money come from?
Well, it comes from the developer's own pocket or from her investors. This is what we call sponsor equity. This chart here, the capital stack, it's like the project's financial DNA. The bank loan, the senior debt, is the biggest piece, sure, but the developer's own cash, her equity, that's the foundation. It's what lenders call skin in the game, and believe me, it is non-negotiable. It's the proof that the developer is just as invested in success as they are.
So, our developer gets her loan, the building gets built, fantastic. But this isn't just about one project. This exact same financial dance happens for every single new building in every city around the world. So, why do these acronyms really matter to the rest of us? Why is this so fundamental?
Because LTV and LTC, they're not just math problems. They are the language of risk. They decide who takes the hit if things go south. They force developers to be disciplined, and they act as this vital signal of the market's health. You know, when you see banks start to get loose with these standards, approving higher and higher LTVs and LTCs, that can be a huge warning sign of an overheating market, where risk is being tossed out the window in a mad rush to build.
So in the end, these two little metrics, they're the silent architects of our skylines. They're the governors that stop reckless development in its tracks, but they're also the enablers that let these bold visions actually take shape. They literally build our world, but they also hold the keys to its financial stability. So the next time you see a crane in the sky, you'll know exactly what's holding it all together.